Silver is currently behaving in a way that has caught the entire financial establishment off guard. For the first time in modern trading history, we are witnessing a price movement that isn't driven by speculation, hype, or the usual market algorithms. Instead, silver has crossed multiple historic resistance levels in a matter of weeks, registering intraday highs that have stunned veteran analysts, seasoned traders, and even central bank officials. This is not the slow, steady climb of a healthy market. This is a violent upward surge born from genuine shortages, severe industrial pressure, and a quiet panic that is beginning to spread behind the scenes of the global economy. And the one institution watching this anomaly closer than anyone else is J.P. Morgan. They are paying attention because the data is revealing a frightening truth that most of the world is ignoring. The global economy is running out of usable silver at a rate much faster than any model predicted. To truly grasp the severity of this situation, you have to look beyond the price charts and stare directly into the major silver warehouses of the world. Over the last 12 months, a dramatic emptying has occurred. The London Bullion Market Association (LBMA) vaults have reported one of the steepest, most relentless declines in available silver stocks since detailed record-keeping began. Simultaneously, the COMEX in New York has seen its deliverable silver category, the metal actually available for immediate settlement, drop to levels that are forcing major traders to quietly and urgently adjust their positions. This is not a seasonal fluctuation. This is a hemorrhage. Manufacturers from critical sectors like solar energy, electric vehicle production, and semiconductor fabrication have started to publicly voice complaints that procurement is becoming unstable. It is becoming increasingly expensive not just to buy silver, but to find it. Even the United States Mint, a government entity with priority access to raw materials, has admitted to having difficulty sourcing silver planchets of sufficient quality to produce the American Eagle coins. When a sovereign mint struggles to find metal, it is a signal that the supply chain has tightened beyond the point of normal market mechanics. Every single one of these stress signals points to a singular, undeniable reality. Demand is exploding while supply is suffocating. This is no longer a theoretical projection for the next decade. This is happening in real time right now, as you watch this video. The panic is not yet on the front page of the newspapers because the mainstream financial press focuses on stocks and interest rates. But in the physical world where industries need actual metal to function, the alarm bells are ringing deafeningly loud. We are witnessing the early stages of a supply crisis that threatens to unravel the pricing mechanism of one of the world's most essential assets. The numbers that triggered this global concern are not just alarming, they are unprecedented. To understand why the vaults are emptying, we must look at the insatiable hunger of modern industry. Silver demand from the solar sector alone has skyrocketed past every projection made just 2 years ago. The new generation of photovoltaic technologies, which are more efficient and powerful, require significantly thicker silver paste, higher conductivity, and more surface coating than their predecessors. The global energy transition that governments in China, the United States, and Europe are pushing with aggressive trillions of dollars in subsidies has created a vacuum for silver that the mining industry simply cannot fill. Solar manufacturers consumed record-breaking quantities of silver in 2024, and the early numbers for 2025 suggest that this demand will rise by another 15 to 20% this year. This means that every single gigawatt of new solar capacity installed anywhere in the world deepens the existing supply deficit. But the pressure does not end with energy. Add the electric vehicle revolution to the equation. Every electric vehicle rolling off the assembly line requires 2 to 3 times more silver than a traditional internal combustion engine car. Manufacturers, who already struggled through the semiconductor nightmares of 2021 and 2022, are now watching the bottleneck shift dangerously towards silver. It is a metal that cannot be easily replaced without sacrificing performance, efficiency, or safety. And just when the market thought it could handle the strain, a new beast entered the arena: artificial intelligence. The massive data centers being built frantically across the globe to power the AI revolution are not just concrete and code. They are dense forests of hardware. These facilities require massive quantities of silver-coated connectors, high-end power distribution systems, and sophisticated industrial cooling components. The growth of AI is not slowing down. It is accelerating faster than experts predicted during the pandemic years. Every additional data center stresses a silver pipeline that is already fracturing. So, what happens when three massive industrial sectors, solar, EV, and AI, continue pulling silver from the market at unprecedented rates simultaneously? You get exactly what we are seeing today. Record high prices driven by hard fundamentals rather than speculation. Warehouse inventories falling faster than they can be replenished. Industrial producers placing emergency orders months in advance just to keep their factories running. And global banks, the titans of the trade, quietly scrambling to adjust their books to avoid getting caught on the wrong side of the storm. This is where J.P. Morgan steps into the picture in a way that should make every investor sit up straight. J.P. Morgan is not just an observer in this market. They are the whale. They hold some of the largest silver-related positions in the world, both in physical vaults and through the accounts of their massive industrial clients. Whenever silver moves violently, J.P. Morgan is invariably one of the first institutions to feel the shockwaves internally. They see the private order flows, the desperate industrial contracts, the delivery failures, the settlement requests, and the cross-border shipment delays long before they become public news headlines. They have a view of the battlefield that retail investors simply do not possess. So when J.P. Morgan releases a warning signal or worse, begins to restructure its own exposure, you know the situation is not a short-term fluctuation. It is a systemic signal. According to leaked internal discussions reported by analysts close to the metals industry, J.P. Morgan believes the world is entering a multi-year, supply-destructive silver deficit that could reshape the global metals market permanently. This isn't simply a price rally to them. This is the early stage of a deeply structural shortage that cannot be fixed by higher prices alone. Why would a conservative institution like J.P. Morgan believe something this extreme? Because the math can no longer be argued with. Global silver mining output has barely moved in the last 9 years. The major mines in Mexico, Peru, and China are producing near their maximum capacity, and many are even reporting declining ore grades. This is a geological sign that the easiest, most accessible silver has already been extracted from the earth. Furthermore, bringing a new mine online is not a quick fix. It takes 7 to 10 years due to complex regulations, environmental approvals, and financing hurdles. But industrial demand is rising every single quarter. In other words, the supply is frozen in place, but the demand is accelerating like a runaway train running downhill without brakes. When this dynamic occurs in any commodity, you get volatility. But when it happens in silver, a metal with a dual identity as both a critical industrial input and a monetary asset, you get something far more explosive. Investors begin buying for protection. Governments start securing metal for national security. And banks begin reevaluating the stability of the paper contracts they have sold. This is the moment J.P. Morgan realized the world was walking into a trap built slowly over a decade, which is now snapping shut. The trap that J.P. Morgan fears is reaching a breaking point because what the public sees on price charts is only the surface of the problem. The real danger lies underneath, hidden in a financial system that was never designed to withstand the kind of physical demand shock the world is experiencing right now. For decades, the global silver market has relied heavily on something called the paper-to-physical ratio. This is a mechanism that allows traders, huge banks, and hedge funds to buy and sell silver contracts without ever actually exchanging the real metal. These contracts represent claims on silver promises that the silver exists somewhere, but they are not the silver itself. As long as only a small percentage of people ever request physical delivery of the metal, the system works smoothly. It is a game of musical chairs where there are always enough chairs because nobody tries to sit down at the same time. But when industrial demand surges, and when investors panic, and when governments begin accumulating silver as a strategic resource, the music stops. More and more entities begin asking for the actual metal, not the paper promise. And that shift from paper to physical is what JP Morgan is quietly preparing for. Because right now, there are hundreds of ounces of paper silver trading for every single ounce of real, physical silver sitting in the registered vaults. This imbalance has grown for years, hidden behind sophisticated trading systems and settlement networks that only a small number of institutions truly understand. When times are calm, those institutions pretend the mismatch doesn't matter. But when stress enters the system real, physical stress, that imbalance becomes a ticking financial bomb. The key question JP Morgan has been asking internally is simple but devastating. What happens when more people want silver than the system can deliver? The answer is not pretty. If too many industrial buyers, sovereign wealth funds, or manufacturers request physical silver at the same time, the exchanges responsible for fulfilling those contracts will run out. They will be legally forced to default on delivery, offering cash settlements instead of metal. At that moment, the illusion breaks. The world realizes that the price of silver was a lie, and that the paper contracts are worthless for anyone who actually needs the metal. This brings us to the final, and perhaps most unsettling, realization emerging from the current crisis. The silver shortage is not just about investment portfolios or industrial delays. It is about a structural breakdown that could redefine global economics. We are moving toward a disconnect where the paper price and the physical price of silver separate completely. Large refiners are already witnessing delays that would have been considered impossible 10 years ago. Manufacturers are being told that lead times are extending, not because of labor shortages, but because the raw material simply isn't there. Premiums on physical bars and coins keep rising even when the spot price temporarily dips, proving that the real market is detaching from the artificial one. JP Morgan has allegedly begun a quiet reallocation of its exposure, reducing highly leveraged paper contracts while securing physical metal through channels that don't attract immediate attention. They are shifting from theoretical ownership to actual ownership. When the largest metals player in the world positions itself like this, it means they expect turbulence serious enough to disrupt the entire functioning of the market. Look at the global geopolitical climate. Nations are no longer buying silver just for profit. They are buying it to secure national infrastructure. Defense technology, from guided missiles to advanced radar, requires silver. You cannot build a modern military or a green energy grid without it. Once nations treat silver as a strategic asset, availability in the open market shrinks rapidly. The world is facing a gap between supply and demand that could reach $1.2 trillion worth of metal in the coming years if nothing changes. This is not a normal commodity cycle. We are facing a structural failure. When the market finally snaps, prices will not just rise. They will likely reset to a level that reflects the true scarcity of the metal. The question is no longer if this will happen, but when. JP Morgan is already prepared. Governments are quietly stocking up. The only people left vulnerable are those who still believe the paper price is real. The silver story is beginning its most dramatic chapter, and the consequences will touch every part of the global economy, from the tech in your pocket to the stability of the currency in your bank account. The shortage is no longer a prediction. It is the reality we are living in right now.